Hi, everyone. I want to talk to you today about facing the single biggest fear in retirement. So, after years of hard work, you're ready to retire. You've been a diligent saver and investor, and you've built up a sizable nest egg that should allow you to maintain your lifestyle for years to come. Your biggest fear is a devastating bear market that depletes the value of your portfolio and puts you at risk of running out of money. Looking back at history, is this fear justified? Well, before we attempt to answer that question, let's just run through some assumptions. Let's say that you start with a portfolio of $1 million at retirement and that your retirement lasts 20 years. And let's also say that you're invested in a Roth IRA where the distributions are not taxable and the gains are not taxable. And you also are not required to take any distributions, so there's no RMDs. Let's then say that you're invested in a simple 50-50 portfolio of stocks and bonds. So 50% in the S&P 500 and 50% in 10-year treasury bonds. Next, let's assume that the only changes you make to this portfolio is rebalancing at the end of each year. So if the weights of your portfolio shift because stocks have gone up, you're going to sell some stocks and buy bonds and go back to that 50-50. If your weights have shifted to the downside because stocks have gone down, you're going to buy stocks and sell bonds to get back to that 50-50. And finally, let's assume that you're going to apply what's known as the 4% rule, which simply means that you take out 4% of your initial balance and then you adjust that for inflation each year to meet your expenses. So in this example, you're going to take out 40,000, 4% of that $1 million, and adjust that 40,000 higher or lower based on the changes of inflation over time. So let's get back to that biggest fear, running out of money, and let's assume that you had the misfortune of retiring at one of the worst periods in history. So today we're going to take a look at three different periods of time that would have been the worst for investors: the end of 1928, after which you would have had to face the Great Depression and World War II, the end of 1961, where you would have had to gone through the Vietnam War and the stagflationary era, so high inflation, low growth, and the end of 1998, where you would have had to go through the dot-com bubble bursting and the global financial crisis. So if you assume that you have retired before these three periods of time, how would an investor have fared? Just first, why did I pick these three periods? They're not the three absolute worst. The three absolute worst would have all been starting around the Depression, just because that's the worst period in time for the stock market, that 20-year period. So I wanted to broaden that to include other periods as well to show different types of risks. So let's start out talking about that first period of time, 1929 to 1948, Great Depression, World War II. How would an investor who started with that $1 million in a 50-50 portfolio have fared with a 4% withdrawal rate? And so here's your starting balance, $1 million. Here's your ending balance, 715,920. So you actually would have fared reasonably well. Now, there would have been some trying times along the way, of course. Those first few years during the Depression, very difficult for the equity market. Those were the largest declines we've seen in US history for the equity market. But by rebalancing back to that 50-50, you would have then benefited by the recovery in the stock market going forward. So certainly a difficult 20-year period for investors, but you would have been left with a pretty high balance given what went on during that period of time. Next, let's talk about 62 to 81. This is the Vietnam War stagflationary era. And again, if you're starting with that $1 million balance, here's what would have happened over time. And so you can see we're left with 792,977. So again, a pretty sizable amount at the end. Here, a different kind of path. The first 10 years were actually pretty good. You actually had a higher balance here in the early 1970s than where you started. But then you had the 73, 74 bear market, which was pretty punishing for investors. And then you had that period of high inflation during the 70s and early 1980s, which were difficult as well, but still comfortable ending balance for that period of time. Finally, I want to talk about the 1999 to 2018 stress test. This is the most recent example where you had the dot-com bubble bursting, and then years later, you had the global financial crisis. So certainly a very difficult period for investors. So 250% plus bear markets. And how would an investor have fared? Here's the trajectory. Starting with $1 million, you actually would have ended with more than $1 million at that end of that 20-year period of time. And the most difficult periods would have been during the dot-com bubble burst, where the S&P was down in 2000, 2001, and 2002, so 3 consecutive years, and then again in 2008 during the financial crisis. So these examples probably provide some comfort to you, but I'm sure you still have questions. There's always a what if, and probably the few what ifs that you're thinking about are as follows. First, you're probably thinking, well, what if you lived 30 years instead of 20? Let's say you retired at 65 and you lived 30 years to 95. How would you have fared in each of these examples? Well, if we look at the first two, you can see very clearly that you actually would have been left with a much higher ending balance than the 20-year period. And why is that? Because the stock market had a great last 10 years during this period of time in both examples. And the third example that we talked about, we don't yet have a 30-year period, but you can see here that the additional years have been beneficial as well, because the stock market was up in 2019, 2020, 2021, each of those years pretty strongly. So investors actually would have fared better had there been a 30-year retirement rather than a 20. The next question you might be asking is, well, what if you used a 5% withdrawal rate instead of that 4% rule? How would you have fared? So you would have then taken 50,000 out to start and adjusted that 50,000 up or down based on the inflation rate. And again, here we're seeing positive ending balances, really not close to zero. It certainly would have been a more stressful period of time for investors, because you're going to have lower balances along the way, but you still would not have run out of money had you used 5% instead of 4%. Now, a final question you might have is, well, what if the future is worse than the past has ever been? What if it's worse than any of these periods that we've talked about? And I think there a few points have to be made. Number one, as an investor, you have to be optimistic. So you have to go in believing that the future is going to be better than today. So you have to believe that in 20 years, real economic growth will be higher, earnings will be higher, and therefore investors will benefit from that. And if you don't feel that way, if you think that the next 20 years are going to be worse than a period where you had a Great Depression when unemployment rates went up to 25%, and you had a world war where an estimated 70 to 85 million people perished, if you think that the next 20 years are going to be worse than that, then I think it's going to be very difficult to allay any of your fears, because that's just a hard starting point to think about. So as an investor, you have to take the counter to that pessimistic attitude. You have to be realistic, where you understand that there's going to be tough times and declines along the way, but you have to assume that the future is going to be better than the past. But let's say you're not a doomsdayer and you don't think the future is going to be worse than any of these periods of time that we saw, and you just want to mitigate the risk of running out of money. Is there anything you can do to control that? I would say definitely there's a few things you can think about. And importantly, these are all within your control, whereas the stock market and what the bond market does, not within your control. These are things you can actually have some control over. So first, you can delay your retirement. So that just means saving more. If you work for a year or two more, you're going to have a higher initial balance, and that's likely going to last longer for you. Second thing you could do is supplement your income. So if using that 4% rule, you have 40,000. If you get a part-time job, you can supplement that, where you either don't have to withdraw as much or you just have more to spend. Third thing you can do, and nobody really wants to do this, but I'm sure everyone can, if they had to find ways to spend less, you could find it. And so that's simply lowering that withdrawal rate. So these are all things you should consider if you're still worried about running out of money during retirement. What you shouldn't be thinking about is selling everything and putting money under your mattress. And so, while in the short term, this might provide you some comfort and you think, I'm not taking any risk, in the longer term, it's actually one of the biggest risks you can take because of this chart right here, which is showing you the purchasing power of the dollar over time. So, because of inflation, if you just leave that money under your mattress, it's eating away at the value of that dollar. You're not keeping pace with inflation. On the other hand, stock market over long periods of time and the bond market to a lesser extent has been a much better hedge against inflation. So, ironically, actually, the biggest risk you can take as an investor oftentimes is not taking enough risk. So, certainly, putting on money under your mattress probably in the long run is not an advisable thing to do, and it's not going to work out very well. So, in terms of the markets, let's come back to the point that you cannot change what the markets do in the future, but you can change the way you think about it. And I think looking at these examples and understanding that retirees have gone through these worst periods in history, have gone through the depression, financial crisis.com, bubble, stagflation, and all the rest of these, and they've gotten through it. And that means that you're going to get through whatever challenges lie ahead. So keep pushing forward and you'll get through it. So finally, I would say face your fears, have a plan, and enjoy your retirement. You've earned it.